1 year ago, we achieved financial independence and retired early. I at 27 and Christine at 31. Now we need our investment portfolio to support us for what could be a 60-year retirement or even longer.
In our last video, we showed you how to calculate how much money you need to retire early. Today, we're taking the next step, how to invest that money so your portfolio can survive decades of withdrawals, inflation, and severe market downturns.
We'll walk you through the exact funds we use to build a globally diversified portfolio and how to choose a valuation-informed allocation between equities and bonds.
We'll explain how our bond 10 strategy helps manage retirement risks and what rebalancing rules we use to keep everything on track. So, if you want to build a portfolio designed to last for the long term,
let's get into it. Let's begin with one of the most common investment questions. How much of your portfolio should be invested in stocks versus bonds? To answer that, we need to first understand the two biggest risks facing early retirees: longevity risk and sequence of returns risk.
Longevity risk is the risk of outliving your money. Stocks can be volatile over shorter periods, but over long periods, they give your portfolio a better chance of growing fast enough to keep up with inflation and decades of retirement withdrawals. Historically, over retirement periods of 40 years or more, portfolios with between 75% and 100% invested in equities have generally produced much higher success rates.
But that leads us to the sequence of returns risk. This is the risk of experiencing poor investment returns near the beginning of retirement. When markets are falling, you still need money to pay for your living expenses. That may force you to sell more shares while prices are low, and those shares are no longer in your portfolio when the market eventually recovers.
That is why two retirees can earn the same average investment return and still end up with completely different outcomes, simply for the order in which their gains and losses occurred.
So early retirees face a difficult balancing act. You need enough equities to help your portfolio grow and last for several decades, but not so much that a major market crash at the beginning of retirement destroys your plan.
Now, let's divide the discussion into two stages: the accumulation stage, when you're still working and building your portfolio, and the retirement stage, when your employment income stops and you begin relying on your investments. During the accumulation stage, sequence risk works almost in reverse. While you're still earning an income, you're usually in a much better position to handle market volatility. If the market crashes, you don't necessarily need to sell your investments to cover your living expenses. Instead, you can continue investing and buy more shares at discounted prices with your income.
In that sense, a bear market during your working years can actually help you reach financial independence faster. A higher equity allocation also gives more of your money the opportunity to compound over a longer period and benefit from the higher expected returns of equities.
In my own case, I kept almost 100% of my portfolio in equities for most of my working years. I didn't even maintain an emergency fund as I had very high savings rate, no mortgage, and no major recurring expenses other than rent. My employment contract included a notice period. Even if I had lost my job, I would have had time to build a cash cushion while looking for another position.
Of course, a 100% equity portfolio is not suitable for everyone. You need to consider how stable your job is, whether your income rises and falls with the economy, and whether you have any major expenses coming up, such as buying a home or paying for your children's education. But when you are still working towards financial independence, it may make sense to hold as much in equities as your risk tolerance and personal circumstances allow.
Once you make the leap to retire early, your investment goals and risk profile change dramatically. Not all retirement dates are equally risky. Your exposure to sequence risk depends heavily on stock market valuations when you retire.
One useful valuation measure is the cyclically adjusted price-to-earnings ratio, or the CAPE ratio. In simple terms, it helps show whether the stock market looks expensive or cheap compared with its long-term earnings.
For the US stock market, historically, when the starting CAPE ratio was below 15, the average annual return over the next decade was approximately 9%. When the starting CAPE ratio was above 30, however, the average real return was around minus 1% per year.
That difference can have an enormous effect on retirement outcomes. One US historical simulation tested this with a 75-25 stock bond portfolio, a 4% withdrawal rate, and a 60-year retirement period. When retirement began with a CAPE ratio below 15, the failure rate was around 5%. When the starting CAPE ratio was 30 or higher, the failure rate rose to around 50%.
As of July 2026, the CAPE ratio for the global equity market is a bit under 30, while for the US it's above 40. This suggests that global equities are moderately overvalued, with much of the overvaluation concentrated in the US, particularly among large tech companies. For someone retiring in this environment, sequence risk may therefore be higher than usual. So, how can we manage that risk?
The first tool is a lower withdrawal rate. For retirement horizons of 40 years or more, a starting withdrawal rate of 3.2 to 3.5% is a more prudent baseline than the traditional 4% rule. Financial blogger Early Retirement Now has proposed a formula that uses the CAPE ratio to estimate an appropriate safe withdrawal rate. Based on that formula, someone retiring today with an all-US equity portfolio may need to use a withdrawal rate of around 3%. That is also our withdrawal rate.
The second tool is a spending guardrail. This means reducing your withdrawals when markets perform poorly and allowing your spending to increase when the portfolio is doing well. We explained how to design those in our previous video.
The third tool, and the focus today, is the bond tent strategy. Here's how it works. During most of the accumulation stage, you maintain a high equity allocation to help accelerate your progress towards financial independence. As retirement approaches, you gradually increase your allocation to bonds. This creates a larger pool of stable assets during what is sometimes called the retirement danger zone. This is usually the first decade of retirement, when a major market decline can do the most damage to your portfolio. Once that period has passed, you can gradually reduce the bond allocation and increase the equity allocation again.
When shown on a chart, the bond allocation looks like a tent. When early retirement returns are poor, the cash and bond portions of the portfolio can be used to cover living expenses. This gives the equity portion more time to recover. If early returns are strong, the equity portion may grow enough that the exact allocation becomes less important.
There is no single perfect shape for a bond tent. Its size and duration depend on your savings rate, withdrawal rate, spending flexibility, and risk tolerance. Here is how we've chosen to apply the strategy. A few years before retiring, we began moving from a 100% equity portfolio towards 80% equities. Rather than selling the stocks, we just directed new investments to bonds and cash-like assets. Now that we've been retired for more than a year, we have been using the cash and bond portion to cover our living expenses. Over the next decade, our goal is to move gradually towards an allocation of around 90% equities and 10% bonds.
Later, when we reach our 70s or 80s, we may increase our bond allocation again. At that point, our ability to tolerate volatility, wait for markets to recover, or replace lost income is much lower. We prefer this flexible, valuation-informed approach to a traditional target date fund, which usually adjusts the portfolio mechanically according to age.
At the peak of our bond tent, bonds represented around 20% of our portfolio. That is at the lower end of conventional recommendations, which may suggest as much as 40%. There are three main factors to consider when deciding how high your bond tent should be. Factor 1. Market valuations at retirement. A bond tent tends to be most useful when valuations are high. Historically, when the CAPE ratio was below 20, bond tents provided relatively little benefit. The reason is fairly simple. Lower valuations usually mean higher expected future returns. In those conditions, an aggressive portfolio with consistently high equities often performed better.
In the current environment, bond tent may be particularly useful for investors whose portfolios are heavily concentrated in the US market. Our portfolio, however, is globally diversified. As international markets are currently not as overvalued, we don't really think a peak bond allocation of 40% is necessary for us.
Factor 2. Your withdrawal rate. A lower withdrawal rate reduces the need for a large bond tent because it's already a form of risk management. As our withdrawal rate is around 3%, we are comfortable maintaining a relatively high equity allocation.
Factor 3, the number of years of spending you want your bonds and cash to cover. You should also include any major one-time expenses that you expect during that period. Our current cash and bond allocation can cover at least 5 years of normal spending, and a large portion of our spending is also discretionary. If needed, we could possibly stretch our cash and bond reserves to 8 years or more. In most cases, that should provide enough time for even a severe market downturn to pass.
The next major question is, what should you actually invest in? We think about our retirement portfolio as having three separate buckets: a cash buffer, a stability bucket, and a growth engine.
The cash buffer holds around 1 to 2 years of essential spending in cash or cash-like investments. This could include savings accounts, money market funds, or treasury bills. We use a short-term ladder of 1-year US T-bills, which currently offers an attractive annual yield of over 4%. Our money is divided among several batches of T-bills. One batch matures every or every other month.
In practice, this works a little like paying ourselves a monthly salary. When a batch matures, we keep what we need for the coming month and then reinvest the remaining amount into a new batch. This bucket gives us regular access to cash without leaving the entire amount sitting in a checking account.
The stability bucket usually holds enough high-quality bonds to cover around 3 to 7 years of planned spending. Its main purpose is to fund withdrawals during bear markets so that you are not forced to sell stocks after a major decline.
There are 4 main factors we consider when choosing bond investments. The first factor is credit quality. We invest in a bond fund called AGGU, which holds a diversified basket of investment-grade government, corporate, and securitized bonds. Investment-grade bonds have a relatively low risk of default and usually provide greater stability than high-yield bonds.
The second factor is duration. For stability, an effective duration of 2 to 6 years is generally appropriate. Duration measures how sensitive a bond's price is to changes in interest rates. For example, if a bond fund has a duration of 6 years and market interest rates rise by 1 percentage point, the fund's price may fall by roughly 6%. This is why the prices of longer duration bonds can move much more sharply when interest rates change.
AGGU currently has an effective duration of approximately 6.1 years. That makes it less sensitive to interest rate changes relative to longer duration funds. At the same time, it may provide more income and potentially more protection during stock market declines than cash or cash-like investments.
The third factor is your spending currency. Ideally, the bond portion of your portfolio should be denominated in or hedged to the currency in which you expect to spend your money. AGGU holds bonds issued across multiple countries and denominated in different currencies. For example, suppose you are a US-based investor who buys Japanese yen-denominated bonds yielding 3%. If the yen depreciates by 10% against the US dollar over the same period, your return in dollar terms would be approximately minus 7.3%, despite the bond itself producing a positive return in yen. Currency hedging helps reduce the impact of exchange rate movements between those foreign currencies and your spending currency.
AGGU is hedged to the US dollar, although the same fund is also available in versions hedged to several other currencies. For us, this is a temporary arrangement. Over the past year and a half, we have been moving between different countries and spending in multiple different currencies. Once we settle in one place, we plan to shift the cash and bond portion into our primary spending currency. That should provide greater stability when we use those assets to cover our everyday expenses.
The fourth factor is inflation. AGGU mainly holds nominal bonds. The payments from nominal bonds are fixed in dollar terms. This means that unexpected higher inflation can reduce their purchasing power and put downward pressure on their prices. To address this, you could add inflation-linked bonds. We prefer to keep it simple and broadly diversified and rely mainly on equities to provide long-term protection against inflation.
The third bucket is the equity portion, which we call the growth engine. As we explained in our previous video, the goal for early retirees is not to necessarily maximize returns in the best possible scenario. The more important goal is to survive the worst realistic scenario without depleting the portfolio during your lifetime. Diversifying across different asset classes and geographical markets can help with that. It means your retirement does not depend entirely on the success of one country, one market, or one asset class.
Based on those principles, we believe that a portfolio of a broad, globally diversified index funds is the strong default choice for early retirees. And that is where we hold most of our investments. At the moment, 76% of our portfolio is invested across 3 funds, SWRD, WSML, and EIMI. Together, these 3 funds gives us exposure to almost the entire world, holding large, mid, and small-sized companies across developed and emerging markets. We hold the funds roughly in proportion to their capitalization weight. Within the equity portion of our portfolio, the current allocation looks like this.
There are 4 main reasons we chose these funds. First, all 3 funds passively track broad market indices. Historically, it has been extremely difficult for actively managed funds to outperform passive index funds over a 10-year period after fees. Passive funds also tend to charge much lower expenses.
For US investors, the choice can be especially simple. A single fund, the Vanguard Total World Stock ETF, or VT, provides a broadly similar global allocation with an expense ratio of just 0.06%. Investors who want more control could instead combine VTI, which covers the US market, with VXUS, which covers the international market.
Second, all three of our funds are accumulating funds. This means that the dividends received by the funds are automatically reinvested instead of being paid to us in cash. Each fund also has a distributing version, which pays cash dividends directly to the investor. We prefer to cover our retirement expenses using the cash and bond portions of our portfolio, instead of depending on the dividend payments. This makes it easier to rebalance the portfolio, sell only the amount we need, and withdraw from whichever asset class which is above the target allocation.
Also, for us, accumulating and distributing funds currently receive the same tax treatment, but that may not be true in your case.
Third, all three funds have substantial assets under management. Larger funds generally have better liquidity and narrower bid-ask spreads, which make the fund easier and less expensive to trade.
Fourth, all three funds are domiciled in Ireland and listed on the London Stock Exchange. For international investors like us, this provides two important advantages over US domiciled funds such as VT.
The first advantage relates to dividend withholding tax. Dividends from US companies that are paid directly to non-US investors are generally subject to a 30% withholding tax. But when those companies are held through an Ireland domiciled fund, the tax treaty between the US and Ireland reduces that rate to 15%.
Based on the average dividend yield, this can save approximately 0.24% per year. On a $1 million portfolio, that would amount to around $2,400 per year. Over several decades, especially when compounded, that difference can become significant.
The second and probably more important advantage relates to US estate tax. US domiciled ETFs are considered US situated assets. Because we are neither US citizens nor domiciled in the US, holding more than $60,000 in US situated assets can create a US federal estate tax filing requirement. The estate may then become subject to tax rates ranging from 18 to 40%. And let's be honest, who would want to pay that?
Once you have decided on a target allocation, you need a system for adjusting your investments when the portfolio drifts away from its intended allocation. This is where rebalancing comes in.
So, when should you rebalance? A practical rebalancing strategy combines regular portfolio reviews with predetermined limits, or rebalancing bands. We review our portfolio every month, but we only make trades when an investment has moved far enough from its target to justify taking an action.
We use what is known as the 5-25 rule. Under this rule, you rebalance when the asset class moves away from its target by either 5 percentage points or 25% of its target allocation, whichever creates the narrow range.
Here is an example. Suppose your target allocation to developed market stocks is 60%. Because this is a relatively large allocation, the 5 percentage point limit applies. You would rebalance if the allocation fell below 55% or rose above 65%. Now, suppose your target bond allocation is 10%. This is a relatively small allocation and the 25% limit applies. You would therefore rebalance if the bond allocation fell below 7.5% or rose above 12.5%. This approach avoids unnecessary trading while still preventing your portfolio from drifting too far away from your original plan.
How do you rebalance? There are two main ways: direct new cash flows toward investments that are below their target, or sell or withdraw from investments that are above their target. In retirement, your regular spending can help rebalance the portfolio naturally.
For example, during a market downturn, stocks fall and become a smaller percentage of the portfolio. You could cover your living expenses using cash and bonds, gradually reducing their share of the portfolio. If the stock allocation falls far enough below its target, you may also sell some bonds to buy stocks at a lower price. However, we don't follow the target allocation blindly. We would generally keep a minimum of 1 year of living expenses in liquid assets.
The opposite process applies after several strong years in a stock market. Stocks grow beyond their target allocation. You can then sell equities to cover upcoming expenses and replenish your cash and bond reserves. Whenever possible, these transactions should also be carried out in a tax-efficient way.
This video already has quite a lot of information in it, so we will leave some other important topics for other videos, including whether assets such as real estate, gold, and crypto belong in an early retirement portfolio, whether a high dividend strategy is a good choice, how to select a broker, and how to think about the risk of a brokerage firm going bankrupt.
If you find this video useful, please give it a like and share it with someone who might benefit from it.
And if you enjoy thoughtful conversations about financial independence, slow travel, and designing a life beyond the traditional 9 to 5, don't forget to subscribe. We'll see you in the next one.
Bye!